Hello everyone, Ross McKinnon with you again to take you through this reading on alternative investments and in particular the asset allocation issues which arise when dealing with alternatives. Okay, so what are alternative investments? I'm sure you're probably well aware of these, but really anything that doesn't fit into the nice traditional asset class universe. So we're looking at things like hedge funds, PE, private credit, simply lending money to a business who needs it, commercial real estate, you've got residential real estate, real assets, assets that you can touch, although in the case of oil and others you might not want to. The role of alternative investments in a portfolio: risk-return diversification benefits. So nice high returns potentially compared to traditional asset classes. That can be seen through a higher Sharpe ratio, higher returns potentially for lower risks as well. And one of the key points is that there's low correlation, so you're getting a nice diversification benefit from having some of the portfolio allocated to alternatives. Okay, so if you've been through some of the previous readings, you'll be aware of a few of these facts already, but just a bit of a primer on the types of alternatives that exist. Hedge funds, largely unregulated. Okay, so yeah, historically, certainly pre-financial crisis, hedge funds were very popular amongst the financial press. You know, lots of column inches were devoted to these. In the previous reading, we looked, if you're doing it in order, we looked at various strategies. So long-short hedging. Short bias is more short than long. Risk arbitrage, lots of different strategies that exist. Okay, there is a whole plethora of different strategies. What do they have in common? Well, overall, low correlation with other assets and a nice reduction in beta, that systematic market exposure, depending on the strategy. Private equity, slightly different. So these investment types, they can be specialised in particular industries. Healthcare is one that's given there, or venture capital. But basically, you're tying up your money to invest either in high growth startups or perhaps in turnarounds of existing businesses. Nice high returns on offer if it goes well. Doesn't always go well, but high returns on offer are available, but limited diversification. Private equity and traditional equities are fairly closely correlated. Also with private equity, we'll see it shortly, there can often be a long lock-up period, similar to hedge funds. You can't easily get your money out of a private equity investment. Private credit, so this really could take two forms: direct lending to a business that needs it, simply as that. Now usually with security involved, okay, so you can lend money to a business with a mortgage, a fixed security on land and buildings. That property is likely to produce income. So direct lending on income producing properties tends to be illiquid compared with tradable debt. Okay, if you do a direct over-the-counter lending agreement and the next day you change your mind, very difficult then to sell that debt on to somebody else. Not impossible, but much less liquid compared to tradable bonds. Distressed debt, we looked at in the hedge fund strategies as well. Distressed debt is where we invest in the debt of companies that are close to or almost at bankruptcy. Actually, the risk-return profile, bizarrely enough, is very similar to equity. So again, perhaps some limited diversification potential there in distressed debt. Commercial real estate, so investing in things like office blocks and hotels. Nice benefit here is that you're almost removing your exposure to inflation. Right? The returns on commercial real estate historically have increased in line with high inflation, so it's an element of an inflation hedge against that particular risk factor. Real assets, those tangible assets that we can touch, lots of different types, of course. Agricultural commodities, things like wheat, orange juice, pork bellies, all the sort of things we saw in trading places. Farmland, metals, oil, tangible physical assets you can touch. Some of these provide inflation protection. Okay, not all of them. So commodities tend to follow inflation, as does farmland and timberland. Interestingly enough, some infrastructure investments don't. So if you want to invest in energy, electricity and gas, and you invest directly in companies associated with that, if in your particular country, if there's regulation, so usually government imposed regulation on how much they can put bills up by, then high inflation will reduce the returns of that energy company and then reduce the returns to its investors. So not all of these would produce an inflation hedge. All right, a couple of slides now on if you're seeking to diversify some of your equity portfolio, Which is the best vehicle for you? Should we invest in bonds or should we invest in alternatives? And the answer is going to be different, and it's going to depend on your time horizon. So in the case of a short time horizon, let's just pop a couple of points up on the slide. With a short time horizon, well, alternatives show lower volatility and low correlation to equities. So sounds good so far in terms of diversification benefits. But the low volatility might be biased. Okay, now, with alternatives, particularly certain types, if you're looking at things like commercial real estate, for example, the frequency of trading of an office block or a hotel is very infrequent. Okay, so when the actual asset itself is sold, there might be years, probably will be years, could be even decades between each sale. So a lot of the time you're estimating the current market value of the property in order to feed into your return calculations. Those estimates result in the smoothing of the volatility. If there's 10 years between sale 1 and sale 2, and it looks like over the piece there's been a nice steady 2% rise, what that might mask, so there's our estimated market price of the property over time. So there's sale 1 and there's sale 2 over 10 years. The only data points you've got are sale 1 and sale 2 at the beginning and end of that timeline. What that might mask is that the commercial property market could be up and down like a yo-yo in between. It could actually be like this. And you're not capturing the true volatility of the asset class simply by taking those sale points, those data points with a long time between them. So the true volatility of alternatives may well be higher than first estimated. Because of that reason, because of the skepticism we have to show to the volatility of alternative investments, we would say that over a short time horizon, bonds are your better bet. Okay, so if you want to diversify risk away from an equities portfolio, bonds have a low correlation to equities, we know that already, and likely to have lower volatilities than alternatives, so that's what you should do. Okay, bonds better over a short time horizon. Over a long time horizon, really the answer changes. Over a long time horizon, you would expect, all things being equal, a higher return on alternatives than you would from bonds. So if you were to hold bonds for a long period of time, the big risk here is that you simply don't meet your return requirements. Okay, the more you've got in bonds, the more depressed your portfolio return is going to be. So allocation to bonds decreases your overall returns. It increases the risk of not meeting your portfolio return. Therefore, with a long time horizon, alternatives are your better bet. They're still lowly correlated with equities. Yes, the volatility short term might be up and down, but over the long term, it's less of an issue. Okay. And don't want to anticipate what's in the exam. I don't think we're allowed to do that. But I think it's easy to see how a question might be written along these lines. It's an easy one for the examiner to go for. So the time horizon will certainly dictate whether alternatives or bonds is your better bet. Okay. In terms of defining the investment opportunity set, alternative investments is quite a wide category of investments. So it might be a nice idea to further subcategorize or to stratify them. We've got various ways of doing that. The first one is using our traditional approach, where we'll classify them by liquidity and how they perform during economic cycles. A liquidity-based approach is where we split it, it's the same sort of thing, but we further subcategorize the alternatives between publicly traded and privately traded. I've got an example of a couple of these coming up in just a second. Any other way you want to categorize investments, it's up to you really. You can categorize them via their performance using different assumptions on economic growth, inflation, interest rates, and so on. Really take your pick. Maybe a trickier one to do is a risk factor based approach. It's always tricky to define risk factors and to estimate how much each asset is exposed to those risk factors, but we're going to try and do it anyway. So we'll try categorize each alternative asset class based on its exposure, its sensitivity to individual risk factors. If you can do it, it's great. It identifies risks that are common across asset classes, helps you identify what the correlation is between asset classes both within the alternatives universe and outside it. What you may well find is that some alternatives are more similar to equities in terms of how they respond to risk factors than you might first have thought. And it just equips the manager with more information to make better risk management decisions. Difficult to do though in practice. A couple of examples then here. So here's our traditional approach where we're categorizing our asset classes based on liquidity. So from more liquid at the top down to less liquid in the bottom. So we've got our traditional fixed income and equity overall arching. So our alternatives might fit into one of those categories. So cash and bonds, well, they're not really alternatives. Private credit, though, would be. Okay, so private credit, simply direct lending to an individual business. We consider that to be an alternative. It's not a traditionally investable asset class, but certainly low liquidity. So in terms of a fixed income type, it's further down the liquidity column. For equity, sure, public equity, shares, it's not really an alternative investment, but hedge funds are. Hedge funds do suffer from a lack of liquidity. Usually a lock-in period, a year, is fairly standard in the hedge fund universe. Private equity is even less liquid. 5 to 10 years, not uncommon to see a lock-up period for that length of time in the private equity sphere. And then other assets, well, these are all really going to be alternatives. You've got commodity futures. Futures is a derivative, so you'd expect it to be more liquid than the others, and that turns out to be the case. REITs, real estate investment trusts, publicly traded, good liquidity in there. Private real estate, the liquidity is declining as we go down here, and then private real assets tend to be the least liquid of all of them. So there's a liquidity breakdown of the alternative universe. For a specific risk, this is one of our other categorization. This is based on exposure to inflation. Well, we've further categorized the columns. Assets which we would expect to have fairly low or indeed negative growth and then high growth. So which perform better with inflation? As we go down the arrow with high inflation, what type of assets are going to do better? Well, index bonds, clearly. Index bonds are index linked, they're inflation linked. So the principal and the coupon, sometimes both, will increase as inflation goes up. So that'll perform better in periods of high inflation than not. Non-index bonds obviously will not perform well with high inflation. Inflation will eat away at the present value of the redemption value at the end of the life of the bond. With deflation, a non-index bond is perfect, isn't it? If you've got negative inflation, it doesn't usually happen, but it can do. With negative inflation, the non-index bond is perfect because it doesn't change. Whereas the index-linked bond, the coupon and the principal would actually decrease. In terms of more high growth types of assets, well, real assets, most of them, not all, perform well with high inflation. Remember, a big exception to that was infrastructure, utility type investments. But things like farmland and timberland certainly would perform well with inflation. Most commodities have an inflation hedge in there. They do well. Public private equity and private credit, not really inflation linked so much. So they're going to perform better in periods of low inflation.